The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Welcome to Stock Tech. My name's Gaurav Sodhi. Joining me today is Nathan Bell. Good day, Nathan.
Morning, Gaurav.
And with us also is analyst Nick Cummings. Hey, Nick.
Morning, Gaurav. How are you?
Not bad, Nick. Thank you. Now, gents, end of the financial year, there's a lot of important stuff to discuss today. Probably the most important thing, Nathan, I think we should take this very seriously. Are England the biggest bunch of whingers in world sport? Nathan, you?
You know, I actually feel bad because I didn't actually watch any of the cricket, but I've seen everyone come out since, and it's a tough call. I used to wicketkeeper as well, and just as a wicketkeeper, your natural instinct is, because often it actually is the reason I liked it was my dad was a wicketkeeper as well, so I just followed my dad's footsteps, but it's also the spot when you're fielding that's got the most action. You know, if you're not a bowler and an opening batsman like I was, then you would have just sat in the field all day. It's the boring as. So I just thought with wicket-keeping, you're always in it. So your mind's always just ticking over about how you can get more into the action and what you can do. And so to throw the stumps down looked to me that was instinctive. And he was out. So, you know, is Pat Cummins really going to go, no, in the heat of an Ashes test, in the heat of the moment when it happened very quickly? It wasn't like he held onto the ball for a long time. You know, is he really going to call it back after that in the heat of the moment when there's so much at stake? I wouldn't have thought so. It's so easy to sit here afterwards and go, oh, you know, even Pricey, the old git on the project, said, this is at night time, it's like the night after, said, oh, yeah, I changed my mind on this and I think it was unsportsmanlike. Well, yeah, you've had 24 hours to sit there and think about it. And he had a half a second to throw down the stumps, make a decision when he was all excited about getting a wicket. So
I'm amazed at the carry on. I really am. This has become an international incident now. Nick, as a semi-professional sportsman yourself, what do you reckon?
I thought it was fair play. I've loved the memes coming out afterwards.
Yeah, I've enjoyed that as well. It's been great, isn't it? Yeah.
Old footage of Johnny Bairstow doing the same thing practically. So, I thought it was play on.
Right. Okay. Pod done. Thanks, boys. We'll see you back all right. Well, we better talk about something to do with finance. The other big thing that happened, probably not as big, but the other relatively large thing, Nathan, the ASX, I heard you say in our meeting that the ASX rose something like 14%, including dividends. The figure I saw from my software was 9 point something percent. So I guess it depends what index you're benchmarking against. But either way, those are extraordinary returns for a year that most people would consider forgettable and where most stocks have actually fallen during the financial year.
Yeah, the final figure was 14.8%. So that first figure you quoted was without dividends.
I see. Okay.
And the 14.8 is obviously with the big dividends of the iron ore miners in particular and the banks, which make up about 40% alone of the index. So 14.8% a year for what is a pretty dull index. And I think what's surprising to me is I was just thinking that, because I always know in my head that the iron ore miners are roughly 20% of the index. I know the banks are similar, a bit lower. You can throw in, depending on which banks you include and financial institution you include. If you want to go into financials, which all of a sudden that number can go up to 30 or 35 or even 40. And the A REITs are another, I think they're at 20% odd. So, you know, CSL, I think, is another 7. So there's basically most of the index. So I'm always thinking of the index as a opposition football team. And I think, you know, what are the good players in the team that I need to beat, you know, each year or over the next decade, and which are the players I need to watch out for, and where's the weaknesses and what can we exploit, and also sometimes you just need to, you know, I think this is a real problem for New Zealand fund managers found this out the hard way, but also US fund managers in particular, and we face it with the iron ore miners, is you might not like the biggest stocks in the index, but if they're cheap or they have a big run, so you might pick out a whole bunch of, you know, the big tech stocks, big tech companies in the US, for example, if they have a big run and you don't own them, like that really does hurt your performance versus the index. And as an individual, you might not care about that stuff, but as a professional funds manager, like all anyone looks at is the gap between your returns and that index. So any fund manager that tells you that they're index agnostic and don't care about what the index does is, yes, that might be true when they put the portfolio together, but I guarantee you every quarter, every month, every year, they are looking at that number and trying to work out how they can beat it. So to get 15% return out of what is a pretty staid index like ours is a huge year, and I don't think it necessarily bodes well for future returns. But it just shows you the power of those dividends, and there's a nice segue there into your thoughts on iron ore at the moment, Gaurav, because a big chunk of that return is the iron ore dividends. And quite interestingly to me is you don't see this very often, and that is the brokers are actually forecasting massive cuts in earnings and dividends for the iron ore miners, yet they're very scared to actually put a sell on it, even though their target price is lower than the actual share price.
Yeah, I just wrote an article about iron ore prices, and it was prompted by that very phenomenon that I think it's very clear to everyone now. The big iron ore miners have been quite open with their plans, and the investments in capacity have been now put down, made, and are happening. And it's very clear now that over the next 5 to 6 years, there is going to be an epic expansion in iron ore supply. The equity markets are pricing it to some extent, but I don't think falls in iron ore prices are being priced in, and there seems to be reluctance to accept that the decade-long average we've had of about $100 a ton is going to fall, and I think that's an inevitability. Iron ore prices are going to fall and fall meaningfully. And for some reason, the equity markets are just asleep at the wheel on this, and I don't see. I can't see that scenario really being priced in. I mean, Fortescue looks cheap, but once you start plugging in meaningfully lower iron ore prices, and as the spreads on their product widen, the profit number really does get decimated, and that earnings number starts to come down quite quickly. So there is a large and clear negative case for iron ore miners at the moment, and I'm amazed not more is being made of it. So it's an opportunity to still get out of these heavily exposed businesses. So I pointed out FMG and Rio in particular. Rio is an interesting case because 80% of earnings come from iron ore, but they have a lot of other assets. I'm decidedly unimpressed with the rest of Rio's portfolio, as I am with the management of that business and the direction of that company. I've been a long-term admirer of Rio Tinto. I think for most of my career, it's been the best mining business in the world. But over the last 5 years or so, it's been a disappointment. I've disagreed with management about the continued investment into Mongolian assets, which I think over time will be shown to be a waste. I think there's already been billions of dollars of write-downs. Returns on capital have been meaningfully lower than what management has promised, and there's no signs of that really turning around. And yet they keep on throwing billions of dollars into those assets to fix the problem, and I don't think that problem is fixable. And then you've got a pool of aluminium assets, which I think are probably due another write-down after being written down about $20 billion already, and persistently poor earners in terms of return on capital. So without iron ore, the rest of the portfolio is really weak, and that's why I think one ought to be negative on Rio Tinto.
It's a strong view out there, and I've seen this a lot because I'm always looking at other income funds to see what they own compared to us, and obviously our funds are always quite different to everyone else's, but I always want to make sure that we're not missing anything or see how we're performing against some of the more popular income funds out there. And there's been a view for a while that the iron ore miners are the new banks. And what I mean by that is there was a period up until sort of 2015, I guess, where the banks had a really strong run where they were paying out these big dividends, and you got the capital gains as well. So you're earning total returns in the teens, which for what should be essentially utility businesses that have utility-like returns, which they almost do now, and it's starting very slowly, I think, starting to get priced like that. The iron ore miners essentially took over from them when people realised there was no more growth in the banks and the capital gains were passed. the iron ore miners have attracted investors, and that's where the big dividends have been. And you've got the big capital gains as well. And so my feeling is, obviously particularly based on your opinions and analysis, is that that's now come to an end, and people are probably still, I think, particularly in this current environment where basically no one just wants to be in a company that's going to have a profit downgrade and see their share price fall 30 or 40%. So everyone's clamoring into the areas where they think there's going to be no profit downgrades, rather than thinking about what are the right businesses that I want to own, even if it's hard to own them because there's a few fleas for the next 5 or 10 years. And that's what I think is still attracting money into the iron ore miners, because we tend to think as the market as this, very smart discounting machine that looks years ahead and incorporates all this current information. But you do see over and over that the market is very slow to move sometimes. And that's why I often look at credit markets for signs of stress in businesses or future capital raise and things like that, because the credit markets do tend to move well ahead of equity markets, and equity markets actually move much slower than you think sometimes, because it suffers from that herding behavior. And I think people are hiding in those iron ore miners like they are with big stocks generally, and that's not where our portfolios are at the moment.
Yeah, and I've noticed that as well, that particularly when something changes, when a trend changes, or when something is new, markets really have difficulty pricing that in. An example of that was when the industrialization of China completely upended iron ore economics in the early 2000s. It took years for the market to correctly price in a large new customer of iron ore. And the last 10 years have been characterized by persistently high iron ore prices, and that's about to change. And again, because we've had this decade of iron ore stability, I think markets are again struggling to price in a significant change in iron ore markets. Nick,
there's also been quite a bit of luck, I think, too, Gaurav, for the Australian miners in particular. You had the problems in Brazil with safety,
yes,
and just
yes.
this huge tonnage come out of the market. Every time China's growth started to slow, the government just forced everyone to lend more money and pump up the economy, and that doesn't seem to be happening at the moment, or certainly nowhere near the degree it has in the past. So that sort of the permanency of those two trends, which have really sort of piled on top of just the good news of China growing generally over the last 10 or 20 years, is starting to fade away.
Yeah, since 2019, I was amazed when I actually looked at the numbers. I mean, everyone knows that there's been problems in Brazil because of the 2019 dam collapse. But when I looked at the actual figures, they quite shocked me. About 80 million tons has been left out of the market, has exited the market from Brazil because of that that dam collapse, and that was sort of 4 years ago now, and it has not returned yet. And it's only now, probably in the next 2 years or so, it's going to start coming back with extra additions. So the market, you're right, the market's been a bit lucky with the absence of those very large volumes. Nick, can I just bring you in here for a moment? Because this 15% return, if someone had told you 12 months ago that the ASX would generate that kind of return, would it have changed the way you allocated capital over the year?
Oh, well, absolutely. I would have gone all in on the large cap stocks, because that's where all the returns are. I mean, Nate was talking about the herding mentality, and it's happening right across the globe. I think 8 stocks in the NASDAQ, or sorry, the S&P 500, have accounted for all the year-to-date gains. So I think Apple, Tesla, Nvidia. Nvidia's up almost 200% since November. It's now $1 trillion company.
Wow.
So more and more these returns are coming from a handful of businesses.
Yeah.
I sent round a graph the other day. I don't know if you saw it, breaking down the ASX returns by actual market cap. And all the returns have come from businesses over $1 billion in market cap. Under $20 million, so the micro caps are down about 50% on average, or median returns per sector. And it was just this, the whole way up as it went, the returns slowly got better until large caps, they became positive. Everywhere, everyone else has been smashed. If you've been a small cap or micro cap manager this year, you haven't got anywhere near 14% returns. It's been mayhem. It's been a disaster. But that's probably where the opportunities now are.
I think the numbers in the big US indexes are actually much higher. I'm not sure what they are, but it's like the NASDAQ up like 35 and the S&P up 20 or something like that.
Yeah, something like that. Yeah, they were coming off a bad 2022, so they're probably down 15 to 20% that year, or last year. But yeah, that's probably right. That it's been crazy, and a lot of the businesses we've looked at in the select value fund have taken off, and now they were buyers 6 months ago, and now they're holds at best.
Yeah, we basically had to completely change the portfolio from sort of 12 months ago when we were first putting it together and what we were working towards. The talking about that 35% gain on the NASDAQ and the 20% in the S&P, like, you know, they're both starting to get back to, you know, their all-time highs, which is just amazing. You've got interest rates that are supposed to act like gravity have gone from, you know, 0 to 5 and to 4 in Australia, and I think 5 in New Zealand, and you know, 3 in Europe or whatever it is, and it's been so fast and rapid, and you just think, oh man, like surely there's going to be a lot of pain, and here we are. It's probably a good lesson in that the market isn't actually the economy. I think it's one of the first things you learn when you read all the old Peter Lynch books and the Buffett letters and stuff, is that, you know, GDP or economic growth has nothing to do with share market returns. It's all about pricing and profit margins, all that sort of stuff. And you know, here we are, and these markets are just up incredibly. And you look at the size, you know, Apple, the first $3 trillion business. You know, I remember it wasn't that long ago when you could buy it for 10 times earnings and no one wanted to touch it.
No one wanted to touch it, Nathan.
Except for smart people whose surname starts with and rhymes with Sodi.
Nick, so what do you think's happening here? It seems to me that this is really motivated by fear. People are getting scared and just piling into big stocks and in an attempt to try and avoid risk. Is it as simple as that, or is there something else going on?
I think to some degree it is as simple as that. I mean, people are moving more and more towards these resilient businesses and happy to pay higher and higher multiples for it, for them. Interest rates have risen from 0% to 5%, you know, in most developed countries, and yet the S&P 500 earnings multiple, the average earnings multiple you pay for the index, is around 24 times. It hasn't changed too much. It's actually probably gone up a point or two, which is just insane when you think about it.
Yeah.
So yeah, I think there is a herding mentality going on, and this is, I mean, there's a narrative behind it. The narrative of the last 6 months is artificial intelligence and those 8 stocks I talked about, that they're going to be the key beneficiaries and everyone else is potentially the losers. So there is some sentiment behind it, but I think it's largely just trying to invest in these businesses that are more resilient and where you have more certainty around their earnings growth, rather than businesses that may look cheap but could have a profit downgrade coming.
Now, we want to touch on Microsoft, a stock you've just written about recently. But before that, Nathan, there's probably people wondering when we're about to launch our AI fund. When is that coming out again?
I still find it remarkable that there's a bunch of AI ETFs that have come out.
Yeah.
And this is not new news, but there are more ETFs than there are stocks out there, which just blows my mind. But you talk about this trend toward ETF or index investing, and 12 months ago, our funds in particular had an awesome period due to your coal picks and a bit of cash and some takeovers. We had a really good sort of initial downturn, if you like, where our outperformance was massive in a couple of the funds. And this year, there's no way our funds were going to keep up with a 15% annual return, and with small caps being as decimated as they are. Just stop this, Riyadh. Sorry, what was your original question, Gaurav? I had a point to make.
The AI fund.
Yeah,
let's get it going.
So there was 12 months ago, you had all these value managers coming out, showing their wherewithal and the patience and how to, wait for tough times, and then we'll show you what we can do. And then 12 months later, we're all sitting here going, the AI stocks have taken off, and the ETFs and the index have all smashed us again. And it's like anyone who thought, maybe, it was the stock, the value investors finally had their time to shine. have just been smashed again by ETFs. And I raised like New Zealand fund managers, I think, have it the worst, because if you didn't own Zero, I can't remember what the number was. It was something crazy, but it come like, was it like half the index or 3/4 of the, whatever it was? If you didn't own Zero, you got absolutely wiped out in terms of relative performance for the index. And it just shows you that I just think investing is getting tougher and tougher, because these technology companies, but in particular at the moment, are getting treated like they're the most stable cash flow businesses in the market. You know, you would never have said that about technology stocks in the past, which would have been your most cyclical businesses. But now that we've shifted to software as a service, and like you ask our marketing team and ask them what's the last marketing expense that they'll cut if we had to go through a recession and save money, and it will be Google. You know, the Google advertising is the last thing we'll cut. So you can understand why people are gravitating to these businesses. But I can also show you a long list of value fund managers who have been saying for 10 years or more, you know, these businesses can't grow that big, otherwise they'll become bigger than the economy and they're going to slow down at some point. And yet they just keep pouring out these numbers that just continue to surprise. But there is a limit to it. But, you know, all of a sudden you find AI and maybe there's a new leg to it. And, you know, maybe the whole AI thing is just a bit more boring, and it's a bit more about increasing profit margins and saving some costs, which is where the real winners are, rather than necessarily being able to pick the next NVIDIA. But it really has been a torrid time for I think, for active value managers. You sort of waited for this long 13, 11-year bull market to end, so you finally had a good crack at some cheap stocks, and it's like always something comes along to boost prices. I think it feels a bit like if you're someone trying to wait to get into the housing market in Australia, it's just at some point you feel like you just got to give up, because there's just always something comes along to pump them up further.
Yeah, I do feel as though investors have been punished for their sense. I mean, the people who have piled into lithium and AI have been richly rewarded, and if you're more cautious and sensible, you've gotten squat. Now, one potential exemption from that, Nick, is Microsoft, which a lot of sensible investors do own. It's also been caught up into this big AI hype cycle. It's a business I personally loathe, for the single reason that during its whole, 30, 40 years of existence, it's never actually released a decent product. Maybe Excel, I'll give you Excel. But everything else has either been copied or is an inferior imitation of an existing product. And it's the capital allocation strategy it's kind of random. They just buy lots of stuff and hope some of it works, and some of it has worked, most of it hasn't. It's just it's a business I really dislike. I'm a big fan of Apple, and I like the focus and the attention to detail that Apple kind of stands for, and Microsoft seems to be the opposite of that. Yeah, this is a business you really like as well. Tell me why I'm wrong about Microsoft. What's great about this business, and why does it deserve all the praise and attention it's getting?
Yeah, well, when I did the research, I was sort of surprised. I always thought of it as this all-powerful company, but when you go back through its history, particularly the Steve Ballmer years of 2000 to 2013, I agree with probably everything you said. They released terrible products. They prioritized Windows over everything else. The culture was shocking. He was dropping zingers like Google's not a real company.
Oh wow! I didn't
and the
hear that.
iPhone
Okay.
and the iPhone wasn't going to take any significant market share.
Yeah, we've all heard that. Yeah.
and by the time he left in 2013 or early 2014, the iPhone had been out for 6 years and had more revenue than Microsoft in its entirety.
Wow.
Which is pretty crazy. And this shows how out of touch the company was. But I think it has regained its focus under its new chief executive, Satya Nadella. He's moved the priorities from Windows to cloud computing and basing everything around the enterprise. So as a consumer, you might actually not like the products, but that sort of doesn't matter. The customer for Microsoft is your chief information officer or your chief technology officer at these multinational companies. And Microsoft's one of the only companies that can offer the whole solution. So cloud computing, office productivity, like a Dynamics 365, which is kind of like Salesforce, LinkedIn, which may look like a random acquisition.
It did, to be fair, yeah.
But it's been a home run.
Has it really? Okay.
Yeah. So they bought this business for $26 billion. It was
Yeah.
doing $3 billion of revenue.
Mm.
It'll probably do 15 billion this year.
Mm.
And it probably has at least, they don't break out its profit margins, but
Mm.
I'd assume at least 30 to 40% operating margins.
That thing, LinkedIn, if there's one business that I just loathe, which I think is just the worst thing for society, it's got to be Facebook. But after that, it's got to be LinkedIn. Like, I cannot stand that product. It is the collection of just of wankers online.
Yeah.
And I'm on it, and everyone I
Yeah.
know is on it, but I hate being on it, and it's awful.
Backslapping professionals.
I really wish it did not exist, and it pains me to hear that it generates so much revenue. Who pays this stuff? I mean, I'm amazed it makes 15 billion in revenue. I really am.
Yeah, it's a combination of premium subscribers and job ads and marketing as well.
Just made me feel very sad, Nick. That is, I'm shocked. I'm shocked.
Yeah.
Sorry to interrupt. Go on. Continue.
I'm here to dispel your loathe for Microsoft and
yes, I know.
bring you back. I mean, the other one too is cybersecurity. Like most people wouldn't realize their cybersecurity business does $20 billion in revenue. It's probably the largest cybersecurity business on earth. So if you're
is that right? I did not know that. Really? Okay.
Yeah, it grew at around 40% last year. It's doubled since 2021.
Wow.
Sorry, 2020. So it's another tremendous business that most people don't realize is inside this sprawling conglomerate. But yeah, everything comes back to the enterprise and to the customer, and they can offer a chief technology officer one entire solution that makes things simple, reduces costs, and improves security. And that's what they're after. They're not after whether yourself likes Excel or Google Worksheets or whether Zoom is better than Teams. It's completely different. That's largely irrelevant.
Now, I know that cloud business has been growing. Azure has been growing amazingly well, and that actually gets decent reviews from customers. Where is that the main driver of growth now for Microsoft? Where else does it get revenue growth from?
It is. So the main drivers, again, are all around the enterprise. So we've got this other segment called personal computing, which pretty much houses anything that doesn't fit the enterprise strategy. There seems to be no cohesive strategy within the division. Each product sort of operates on its own. So products in there are Xbox, Surface, Windows, and Bing. Search. They're the large ones.
Every brand you just mentioned there is crap. Xbox, Surface, and Bing, each of them is inferior to the original that they're trying to copy.
No, they are. What I will say is despite them being crap, the operating earnings of that division have doubled in the last 5 years from $10 billion to $20 billion.
It's a very depressing conversation.
so someone must like them.
Wow, someone must like them. Yeah.
But you're right. The main drivers are cloud computing through Azure, where they're the number 2 player behind Amazon Web Services. And we've thrown out some numbers on how big this industry could be. I mean, there's lots of estimates out there, but something like $500 billion by the end of the decade is not out of the question. It's already a $200 billion industry. And it's already, at least in Western markets, pretty much an established oligopoly between Google Cloud, Microsoft, and AWS. So that alone for Microsoft could be a $150 billion business, I think, by the end of the decade. And that's on a current revenue base of 200 billion. And then you've got cybersecurity, Dynamics, and Office 365, where they raised prices and added new users each year. So there's a credible growth. It's credible to achieve at least 10 to 15% earnings per share growth for the best part of the next decade, I believe.
Wow.
However, that's a lot of that's in the price.
What sort of valuation does it? I mean, I know there's not a lot of enthusiasm about it. Is that obvious in the price?
Yeah, it's about 33 times earnings. Which, if you assume it keeps its current multiple, then you just get the earnings per share growth, which would be a fantastic return for a quality business like this. But 6 months ago, it was 22 times. The next 12 months earnings. So that's sort of taken it away from us out of. It probably would have been a buy 6 months ago, but we're currently sitting on a hold recommendation.
I think one of the advantages Microsoft has had is if you go back before these sort of current giants of tech, anytime, I mean, if you read some of those old books about Intel and whatever, and it says something about the difference between the business as well, but if you missed a particular stage of technology advancement, then it probably eliminated your business. You know, IBM's never really recovered for decades. Intel's still struggling. Again, different businesses, but the advantage Microsoft has had is it's always just had basically everyone as a customer. You know, everyone's touched by a Microsoft product at some point. If you work in an office, for sure, and there's probably something on your device that you use. And so if you happen to miss something, which Microsoft did under Barmer, and probably missed a couple of things, major turning points, they actually had the resources and the customers to recover. So they were able to actually invest fairly quickly and essentially copycat like you talked about. And actually, it's not always the worst thing to copy. Even though it might be an inferior copy, the fact that you've just happened to have all the customers and they're happy enough with it, and maybe you get it at a discount because you buy other services as well, and so it all gets wrapped up together, and you don't really expect too much more. You're not expecting an Apple-like product when you buy a Microsoft-like product, and it's cheap and it works and everybody can use it, and you're sort of used to the format because you've been using their other programs. It's a powerful thing, and I think that's part of the reason why Microsoft has been able to recapture its former glory. But you wonder where the company would be without the cloud, which was really the big thing in terms of just profitability. And that was a huge turning point, not just for them, but it completely transformed Amazon as well.
I think sometimes the thing that gets forgotten about Microsoft is how successful they are as an enterprise sales organization. I remember reading an article about Google Cloud versus Microsoft Cloud, and Google engineers were just aghast at Azure. They just thought they had such a better product, generation ahead of where Azure was. And maybe that was true, I don't know, but the engineers themselves were amazed at the Google product, disappointed with Azure. But Microsoft had an experienced enterprise sales team, and they could go around, wear suits, shake hands, and speak the language of enterprise. Whereas Google sent out these kids in shorts and sandals, and they just could not get through in terms of relationships with their enterprise customers. And Google had an enterprise sales problem, whereas Microsoft had decades of experience, and that is the real reason why Azure is cannibalizing cloud, and why Google Cloud is struggling relatively, trying to take off. And you can replicate that story with pretty much any product, and Microsoft sales team is just incredible.
Distribution is definitely key to Microsoft. I mean, they have, I think, over 1 million resellers and partners across the world, and some of these are quite big businesses. I mean, Dicker Data and Data3 that are listed in Australia, probably 10 to 15%, I'd guess, of Dicker Data's business is Microsoft alone. So they've created billion-dollar businesses within their partnership ecosystem. And so when they have a new product like Azure, they can offer these resellers better prices and larger promotional discounts to go and really sell this product and jam it down clients' throats. Whereas Google never really had that. It took Amazon years to develop that, but they had a head start on Microsoft of probably about 5 years. So they were able to sort of get to the number one market share, but Microsoft is quickly catching up. So in the last probably 4 or 5 years, it's probably gained 5 or 6 points of market share compared to Amazon Web Services. Amazon hasn't lost any, but Microsoft has been catching up.
And can you just run us through, I mean, I've been hearing that the integration of ChatGPT inside the Office suite, it's just getting, the beta results are getting rave reviews from anyone who's seen it. Could that be a game changer for Microsoft? So, I mean, why even bother to do that? Because who else is there to sell the product to? How does that benefit in terms of revenue and finances for Microsoft?
I guess that's probably the big unknown. I haven't really penciled in anything because it's so hard to predict. I mean, this is, as you said, a beta product. So it's called Copilot 365.
Yeah.
And this will run pretty much from your email, through Excel, through Word, Teams, and even onto the Bing search engine. And so it'll be pretty much seamless to move information within an organization, or at least more seamless than it is now. Originally, this was launched with OpenAI, so that is the founder of ChatGPT. So they took a 49% stake in that business for, I think, $10 billion. It's
incredible.
Yeah, it's still very murky what the actual relationship is here, in terms of Elon Musk, who was actually the founder of OpenAI, says it was set up as a non-profit business, but now it's a for-profit business. Now Microsoft's a partner. I think they have the right to earn back their $10 billion investment through profits, and then the company has a capped profit, and then the rest will be, I guess, non-profit. So it's complicated exactly what the relationship is going to be. But Microsoft's goal is pretty much to use AI to improve the productivity as enterprise. And I think this goes back to what we were saying earlier, that everything at Microsoft revolves around the enterprise. The other thing they've done is launch this direct attack against Google search through Bing, and that ChatGPT used alongside Bing will be far better than Google search. So that was the big question at the start of the year. Google's brought their own products out through Bard, which you can use now in Australia. It's not as good as ChatGPT, but they've promised. I think the Google CEO said that's the Honda Civic, and we're about to release the Ferrari. So it's still it's still up in the air exactly how all this plays out.
Yeah, fascinating. Okay. And Nath, we don't own Microsoft in the portfolio yet.
No, we do. We do have some.
Oh, we do. Okay.
It's just it's not cheap enough to make it a buy yet.
Okay. All right.
Like it's an incredible business, and again, you look at these businesses, and most of the time they're very highly priced, and you think, oh, geez, I'm just never going to get a chance in a business like this. And yet, it wasn't that long ago where Microsoft was being absolutely caned by any international fund manager that had to speak on it. Just talked about all the missteps they'd made and all the rest of it. But that was the opportunity. I think the stock is probably up, 10 or 12 times now from that bottom. And you're talking about, John's made his point, with you two owning Apple over the last 10 years or so, just one of the most covered stocks on the market, bar none. And yet you've made, 8 times your money or whatever the number is. Like, it's just because a lot of people covering it doesn't mean their analysis is right. And I'm starting to appreciate just more and more. It's not that people are wrong or they're dumb or anything like that. It's just that most people are just operating on a 6 to 12 month basis. That really accounts for a lot of the difference between views, I think, on stocks. And I'm just seeing some just complete anomalies in the market at the moment, just really stupid stuff. And look at a lot of the articles in the Fin Review are just about these stocks that I have no interest in whatsoever, and yet some of them are like, one of them's a $3 billion stock. I'm not going to name it, but I was just looking at a list this morning to see that showed some of the best performers in the index this year, because when I just thought about it in my head, as we did at the beginning of the show, about those sort of major sectors, like none of them have been particularly good, except for the iron ore miners have been okay. But there was all these other companies like the lithium businesses and the other speculative stuff and other tech companies that were already expensive and then they've doubled. It's again why I just feel like it's just a really difficult market, and just shows the age-old quote from Charlie Munger that if you think investing is easy, you're stupid.
Yeah, I think a lot of small cap investors get that wrong as well, that they think you can only find mispricing or opportunity in the absence of other people looking. There has to be no coverage. It has to be undiscovered. And I've always my experience with Apple has really informed this view, but I've always thought that that's not true. The way the market works is one opinion actually influences another opinion. So the more opinions you get, the more views, the more eyeballs you have on a stock, the more opportunity there is for a consensus to build, for herding to happen, and for mispricings to follow. And that's always been my view. I've made far more money out of large, well-covered stocks that are all following a narrative or a story than I have out of some obscure business that no one covers and they're technically mispriced. And I just think small cap managers continue to get that wrong. And I think a lot of individual investors underestimate what one view or one analyst's view does to another analyst's view.
It's funny. It's funny the biases and the reasons we come up with for not buying things sometimes. And I'll tell you a quick story. I won't say who it was, but a guy who had Apple products everywhere. Like he loved Apple products more than anyone I knew. So he knew the business, and he also knew that the sort of non-traditional parts of Apple was really starting to grow now. So it wasn't just the iPhone, it was just the other bits and pieces. And so we're going back now, this is, I don't know, 7 or 8 years maybe, whenever Apple was about 10 times earnings. I think it was about 2015 or somewhere there. And everyone was saying, oh, it's gone X growth, classic quote, X growth.
Yep.
And yet, so he knew, as an analyst, as a customer, as an experienced fund manager, from every possible angle, he knew this business. And he could see how cheap it was, and he just couldn't buy it. And I don't actually know why he wouldn't buy it, but I don't know whether he just thought it was too easy or
too easy.
A bit like, what's that story where you're a value investor and if there was really $5 on the ground,
it wouldn't be there.
Yeah.
Yes, that's right.
So you don't pick it up. It's just one of those classic situations. So sometimes the value is just staring you in the face and you even know it, but you just don't, I don't know, you just don't process it properly, or you just don't realize what it could be, or
I remember doing that myself. I remember years ago with II, actually, we had upgraded Woolies. It was probably 17, 18 bucks. It was when the profit margins had collapsed. Woolies was going through a bit of a funk. The share price had fallen a long way. All of you guys were buying Woolies, but I was sitting there thinking, I don't do this job so I can buy Woolies. I don't want to buy Woolies. And it made a 50, 60% return. I'm just thinking I could have put enormous amounts of money behind that idea. That was a no-brainer. And I've never forgotten that lesson. There's too much pride that can come for, I think, professional investors, and that was prime example of it.
At the start of your career, where and particularly our culture at II was like that when we came in.
Yes, that's right. Yeah,
the esoteric.
Yeah,
and you're trying to find the undiscovered and show how clever you are, because you can find the cheap statistical overlooked cigar butt or whatever it is, and then you just look back over the last 15 years and seeing what's worked, and it's just find the best stuff. Just that, we were upgrading. CSL probably a little bit slow too, but Cochlear, I remember, was always there, and I'm sure there was a couple of others.
I'll always credit you for the CSL buy, which I made 10 years ago, and I still hold today. Been the 10 bagger for me, and I just love that you didn't buy a dollar of it. And I was working for you at the time when I bought it. I just think it's hilarious.
Yeah, I've told this story many times, but I remember sitting there because I was still pretty green then. I hadn't been an intelligent investor very long, and CSL wasn't talked about in the same way it is today. And it was going through a tough time, and I think it was $33, and I was just looking at this thing going, why haven't we upgraded this thing? It's got sort of everything we're looking for. And there was some technical stuff why I thought it was cheap, but it was different this time. The plasma supply glut wasn't going to last this time because the industry had been consolidated. So this thing was on 17 times earnings, which is sort of 17 back then is like 30 today. And I didn't buy it, but I remember sitting there going, geez, I reckon this stock could get to like $40 in the next 2 years.
Add a zero onto that.
Then it went back to 29, and I thought, oh no, I've got it wrong. This is a disaster. And then went to $330 or something.
All right, Nick, you got to tell us how dumb you've been with some story, because we're feeling a bit underdone here. Come on.
Oh, the dumbest thing I've done was in PayPal. So it was a successful story to start with. I'd done all the work on PayPal 6 months before the pandemic, and then the pandemic hit, and it's a digital payments business. It's down 40%. I thought the impact wasn't actually going to be that great on the business. So I recommended to the portfolio manager of my last job that we buy it, and we did. It went up 3 times. It went from $80 to $300.
This is not sounding like the kind of story I wanted to hear.
I'm getting to it. I'm there, patting myself on the back. And they released this. There was an analyst day, and they had these optimistic projections of what they're going to do by 2025, and everything seemed cozy and great. And then they came out, there was a rumor that they were going to buy Pinterest, which was just so far out of left field.
Mm.
It was, I was just, taken back by the thought they were going to buy a social media company, this beautiful payments business, and they're going into this, crappy industry. They came out and pretty much said after the share price fell 10%, oh no, we've listened to our shareholders, we're not going to do that. But that was the key, that growth in that business had pretty much flatlined. So e-commerce growth
Right.
had stopped by the end of 2021 or slowed down dramatically. And I just always remember thinking back to it and I knew everything about that stock. I knew there was competitive threats, and I knew that was probably a signal, but for whatever reason, I just was hanging on to this winner and hung on and hung on. And I think it's now at $60. So
That's
gone.
painful. When you see your gains evaporate, that's probably worse than sitting on losses. I reckon that's awful.
And this is not a small business either. I guess to highlight how crazy it got, PayPal was worth more than MasterCard at one point in 2020.
Oh wow, I didn't know that.
Yeah.
Okay.
And now it's, worth a fifth of MasterCard.
Astonishing.
Yeah.
I've got one more quick funny story for you, and maybe we could finish up on this.
Yeah.
And a friend of mine told me the story when he first started out at a well-known growth fund manager. So I'm guessing this was probably 20, 25 years ago. And he told his boss that Fish and Pockle Healthcare were just selling fancy vacuum cleaners. and there was no way that this company was going to earn excess returns. I think it's up over 100 times since then.
Wow. That is an embarrassing story. You got to tell me who that is later on. Definitely off air.
He's got another classic too with Mainfreight, which I don't think he got the analysis wrong, but he owned really, really early. And again, I think he owned it for went up 2 or 3 times and thought he'd done fantastic. And then I think it went up another 70 times or something.
Wow.
Incredible.
Yeah. That is actually, that deserves a story and a write-up. Like Mainfreight is one of the most amazing businesses to come from this part of the world.
Your wish is our command, or Nick's command.
Yep, that'd be awesome. I'd love to read that. That'd be fantastic.
Stay tuned.
There's a good book on Mainfreight as well, which I believe I'm supposed to borrow from you at some point, Nick.
This one here. That's no plug. I've just got it.
Yep. I'd love to get that off you next time I see you. That'd be good.
Yeah, ready, fire, aim. It's brilliant.
Now we're forgetting we're actually on a podcast, so we actually roll up, and that might be it for today. But we've committed to doing this fortnightly. This is the first of that commitment. We'll be back in 2 weeks, so stick around. Nath, thanks very much for your time today.
Thanks for doing it while you're under the weather, mate. Much appreciated.
Yeah, not feeling 100% today, but we'll get back shortly. We'll be better for next time. Nick, thanks for your time as well.
Thanks very much.
And for everyone else, thank you for listening.